Hello and welcome to this video on how to use the Relative Strength Index, RSI, for crypto trading. In this video, we'll be discussing the basics of RSI and how it can be used to make informed decisions while trading cryptocurrencies. Firstly, the Relative Strength Index is a technical analysis tool used to measure the strength of a particular asset's price action. It ranges from 0 to 100 and is calculated by comparing the average gains and losses over a specified period of time. Now, let's move on to how you can use RSI in your cryptocurrency trading strategy. One common way is to look for divergences between the price and the RSI. For example, if the price of a cryptocurrency is making lower lows, but the RSI is making higher lows, this could indicate that the asset is oversold and could be a good buying opportunity. Another way to use RSI is to look for overbought or oversold conditions. When the RSI is above 70, it's considered overbought, and when it's below 30, it's considered oversold. This can give you a signal to potentially sell or buy, respectively. It's important to note that RSI should not be used in isolation, and should be combined with other technical analysis tools and fundamental analysis for a more well-rounded trading strategy. Now, for our bonus point, when using RSI for crypto trading, it's important to be aware of the volatility and potential rapid price movements in the cryptocurrency market. Therefore, it's recommended to use longer time frames for RSI calculations to smooth out some of the noise in the market. That's all for this video on how to use the Relative Strength Index for crypto trading. Thanks for watching, and we hope you found this information helpful in your cryptocurrency trading journey.